In this episode, we will see who is actually trading the Forex markets. Well, even though the answer is very simple, everyone at some point traded FX. We will use an example. Let's take Nisse. Buyers and sellers and some place that can control the market. This is a very simple structure. There is only one entity that controls prices. For this example, we will call it the box. All traders must go through this box because there is no competition. Prices may be altered. Why and how does this happen? Well, the box is forced to fulfill the orders of its client. Now let's say that numbers of sellers suddenly exceeded the numbers of buyers. The box is forced to fulfill the orders of its client, the sellers in this case, is left with a bunch of stocks that he cannot sell. In order to prevent this, the box will simply widen the spreads or increase the transaction cost to prevent sellers from entering the markets. Remember the opposite reaction. While you are selling, the box is buying. But now the box manipulated the prices. While trading spot FX is impossible as it is decentralized, in FX, you don't need to go through a centralized exchange like the box we described earlier, with just one price. In the Forex market, there is no single price for a given currency at any time, which means quotes from different currency dealers vary. We will give examples of how low capitalization markets can be manipulated, but it's too early, so let's continue. Due to the huge competition in FX market and size, you can get the best deal almost every single time. Yeah, I know, you like it. Keep in mind that in the FX markets are the most chaotic and unpredictable markets. Something that is also awesome while trading FX is that you can do it from any place you like. There are several levels in financial markets. Starting from the bottom, we are the retail traders, the little bags that we are trying to make it through. Above us are some bigger bags that have more needs, and they also need to trade FX. For example, a huge American company with offices in Japan has to pay employees in yen, no matter what is the exchange rate. Of course, big companies and treasury department is another story, but we are simplifying the example to make it easier to understand. In this category are also hedge funds, some retail CCNs, and retail market makers. In the next level, we have some medium-sized and small banks. These organisms are small local banks that also try to find the best prices in FX market to exchange their currencies and serve their clients' needs. As we proceed further, we see Reuters dealing 3000 spot matchmaking service and EBS, a wholesale electronic trading platform used to trade on the FX market with market making banks. Think it like two huge players that deal with the market. The competition between the two companies, EBS and Reuters, is huge. They are in constant battle for clients and constantly try to have an advantage over each other for market share. While both companies offer most currency pairs, some currency pairs are more liquid on one than the other. At the very top of the Forex market is the interbank market. Composed of the largest banks in the world, the participants of this market trade directly with each other or through voice or electronic brokers, such as EBS market and Reuters matchmaking we described earlier. Now that you know the basics, let's see each Forex market player and dive deeper. It's important to understand the nature of the spot Forex market and the main Forex players. Until the late 90s, only the big boys could play this game. The initial requirements was a couple of millions, from 10 to 50, just to start with. Make sense? Well, remember what we said about leverage and some other tools that were not available back then. Forex market was intended to be used by bankers and large institutions and not by us. However, because of the rise of the internet, online Forex brokers are now able to offer trading accounts to little bugs like us. In Forex market, the boys are the super banks. Since the Forex spot market is decentralized, the largest banks in the world determine the exchange rate. Still, rules of supply and demand are there. These boys are generally the ones that make the bid-ask spread that we all know, and you should already know if you check our previous episodes. This large banks is known as the interbank market or flow monsters. For these flow monsters, the name of the game is volume and capturing their share of the trading flow of currencies. Some examples are Goldman Sachs, JP Morgan, UBS, Citi, Barclays, Deutsche, HSBC, and Bank of America, and many others. Next in the list, we have some huge commercial companies. Companies that take part in the foreign exchange market for the purpose of doing their business. Remember the example we mentioned. An American company must pay employees in Japan in yen, and if he also buys some material from Australia, let's say, then she has to pay in Aussie. The volume is much lower, and usually those players trade with local banks. We have also some other major players, governments and central banks, such as the European Central Bank, Bank of England, Federal Reserve. Their decision affects the currencies. National governments participate in the forex market for their operations, international trade payments, and handling their foreign exchange reserves. Central banks affect the forex market when they adjust interest rates and when they are taking decisions about monetary policy. For this topic related to so important news like rates and also any other news related to monetary policy is a part of the fundamental analysis that we will see in the future with details. Their decisions can significantly affect currencies. There are also instances when central banks intervene either directly or verbally in the forex market when they want to adjust exchange rates. Sometimes central banks think that their currency is priced too high or too low, so they start massive sell or buy operations to alter exchange rates. Their announcements can be hawkish or dovish, depends on what they want to achieve. Again, this is another part of forex analysis that we will discuss later in our series. In the bottom of the food chain is us, the speculators, the retail traders, buying and holding foreign currency in the hope of selling that currency at a higher exchange rate in the future, or the opposite. We don't trade forex because we have to. We do it in order to make some profits. However, the numbers reveal the reality. Most forex players lose. Now the analysis and the reason vary, and this is the main purpose we created this series. Stay tight, cause the trading journey is too long and rough, but it can become very rewarding. It's a zero-sum game. For every loser, there is a winner. Speculation in the forex market involves the buying and selling of currencies by using leverage, a high-risk product dedicated to blowing up your account. The element of proper money management will be discussed in this series, and trust me, it is the hottest topic. We are focused on price fluctuations. No one knows when the market will go. Based on our analysis, we try to make some profitable scenarios, repeat the process, and establish a trend of good habits. It is a pure speculation with uncertainty. No one can know for sure whether a currency pair will go up or down. We come in different sizes, shapes, background, education, wallet size, and so on. However, I can guarantee that we all fight equally. There might be some better treatment in spreads and some other commissions or fees, but trading forex is a game that everyone, and I mean it, everyone, has the same access to the same information. You will catch yourself trading against 70%, 80% in the market. Thinking different is a good start. It's important to know some information about Forex history and some facts. So how Forex started? We didn't have any bank system to know for sure the exchange rates between currencies. This information came later on. At the end of World War II, major Western governments felt the need to create a system to stabilize the global economy. This is known as Bretton Woods system. The agreement set the exchange rate of the US dollar against gold, which allowed all other currencies to be pegged against the US dollar. This considers the most important act for the US currency, as winners makes the rules. The US manages one of the biggest success in the history, their history, for generations to come. This stabilized exchange rate for a while, but as the major economies of the world started to change and grow at different speeds, the rules of the system soon became obsolete and limiting Bretton Woods system. In 1971, the Bretton Woods Agreement was replaced by a different currency valuation system. Not many things changed, with the United States in the pilot seats. The currency market evolved into a free-floating one, where exchange rates were determined by supply and demand. It was too difficult to determine a fair and true exchange rate value, but advances in technology and communication eventually made things easier. With the rapid explosion of information and internet after 1990, banks began creating their own trading platforms. These platforms were designed to stream live rates to their client so that they could instantly execute trades themselves. Then we are having retail brokers. These brokers make it easier for retailers to use smaller trading size. For example, in the interbank market, the standard trade size is 1 million units. Retail brokers allowed individuals to trade as little as 1,000 units. Retail forex brokers changed the history of forex trading. In the past, only the big speculators and highly capitalized investment funds could trade currencies, but thanks to retail forex brokers and internet, this isn't the case anymore. With zero entry barriers, anybody could just contact a broker, open up an account, deposit some money, and trade forex from the comfort of their own home. We will discuss about the brokers and how to find the ideal one, but for now we don't need this information. Brokers come into two forms: market makers and electronic communication networks, ECN. Market makers make their own game. You could say that market makers are the fundamental building blocks of the foreign exchange market. Remember what we said with the example when traveling to Japan. When you want to exchange your yen, you need to give your USD. So in this case, we have the opposite side. While you are buying sell, the market maker will sell it to you. They manage to make profit from small differences in bid-ask prices. Market makers basically provide liquidity by breaking larger contract sizes from wholesalers into smaller pieces. Without them, it would be very hard for the average to trade Forex. Electronic communication networks. They automatically match customers' buy and sell orders. So let's say you want to buy yen at 140. They automatically find the best matching price. They gather the prices from market makers, banks, and even other traders who use the ECN. Whenever a certain sell or buy order is made, it is matched up to the best price. Due to the ability of traders to set their own prices, ECN brokers typically charge a very small commission for the trades. The combination of tight spreads and small commission usually makes transaction costs cheaper for ECN brokers. Thank you for watching this video. Go back, repeat the chapters you are not sure about, and subscribe to help us make more content.